All right, good afternoon or good morning to everyone. Welcome to the loan officer training with the mortgage calculator. Give us just 1 minute here to go live on all the different platforms. Definitely appreciate everybody tuning in nice and early. Hope you're having a great day and ready to talk about today's topic. And it looks like we're live on all the platforms. We'll go ahead and get started. You can keep dropping comments there in the chat. You can also drop any questions you have in the chat as well. All right. So, welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non QM loans. And what we do every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern is our loan officer training topic. And we have a great topic here for today, which is the difference between a pre approval and a pre qualification. So, very important training here today. So, Jose, let's get it started.
Good afternoon, everyone. Thank you for joining us for today's training on discovering the difference mortgage pre approval versus mortgage pre qualification. This is definitely one of my favorite topics here because, every now and then we get that question from MLOs. Why do we have to pre approve the borrowers? Can we just provide a pre qualification? Right? And then we obviously have to explain to them the difference between the pre qualification and the pre approval, right? It's all about adding value to the transaction, especially our credibility as the loan consultant for the borrower. So just posing that question would definitely be an inexperienced MLO, most likely, who hasn't had a supposed pre qualification blow up in their face once they actually run DU or LP on an agency loan, that they had pre qualified the borrower without getting an actual credit and income pre approval. And then all of a sudden, the borrower is holding an empty bag and is very upset that their deposit is in jeopardy. It could be thousands of dollars that the borrower may lose, and an NMLS complaint for the MLO for not properly providing an accurate pre approval. So let's get right into it right now on discovering the differences. Remember, this is about adding value and building credibility. So, as we all know, a pre approval is an in depth evaluation of a potential borrower to determine for which programs they qualify. It can be either a purchase pre approval or it can be a refinance pre approval. A pre qualification, on the other hand, is an unverified, and I stress unverified, review of the borrower based on self reported information. That's another key component there, unverified review, self reported borrower information, and usually without a credit check. At most, what may happen from a pre qualification is maybe the MLO does a soft pull, right, to not affect the borrower's credit score until the borrower really decides what they want to do. Now, be aware of the following when you're considering offering a pre approval or a pre qualification. Now, I will stress the following: at the mortgage calculator, we do not encourage our MLOs to provide borrowers with a pre qualification letter, right? As you'll see when I explain how we actually use or how a pre qualification can be used, but we would never ever tell the MLO to issue a pre-qualification letter to any borrower. We only issue pre-approval letters at the mortgage calculator after the borrower is thoroughly credit and income approved. So I'll get into that when we get to the slide. But be aware of the following: listing agents, for especially for those of you that are in tight inventory markets, you have to be aware listing agents generally require that an offer be accompanied by a pre approval, not a pre qualification. And we're talking about pre approval. If it's an agency loan, they're going to want to know that the borrower receive AUS approval. Obviously, if it's a non-QM loan, AUS is not applicable, so you're going to have a very thorough letter with possibly additional documentation to prove that your borrower is really pre-approved. Please also be aware, especially for those of you that are working with real estate agents as referral partners, buyer's agents generally require a buyer be pre-approved before showing properties. That's why they're referring you the borrower in the first place, so you can thoroughly vet the borrower and make sure that the borrower is a viable candidate for a purchase for the programs that they're seeking. A solid pre-approval also allows for budgeting and financial planning. It also um, affords a more focused and efficient process, and here's the important part, resulting in higher success and satisfaction for all involved parties. And hopefully, if you do a great job and give us, very accurate pre-approvals at close, it will result in a steady stream of referrals and a sustainable MLO career. So these are all great reasons why you would provide a pre-approval instead of a pre-qualification. But let's break it down a little further so we can add a little bit more detail here. Now, the pre-approval is a more in-depth process which involves verification of the financial documents provided by the borrower and a hard credit pull, right? Uh, Especially if you're dealing with an agency loan. If you're dealing with an agency loan, the only way we're going to be able to run automated underwriting is if you have a hard credit pull that can be reissued into the automated underwriting system. And for non-QM, I did mention automated underwriting is not applicable, but it will require a thorough non-QM guidelines review for the specific option that is being selected for that borrower. Remember, in non-QM, you cannot generalize guidelines, right? They're not homogeneous. They do vary from investor to investor. And what I'm talking about here, when I'm referring to investors, are the investors who are purchasing the loans, not the investor who you are making a loan to, but the investors purchasing the loans. So all those guidelines are going to be different. So make sure you are evaluating the borrower based on the specific pre-approval, the specific guidelines, excuse me, that you're considering, the specific product option guideline. A pre-approval also has a set expiration date based on the documents provided. In other words, a credit report is going to be good for a certain amount of time. If it's a full doc borrower with pay stubs, you're going to be looking at 30 days, because after 30 days, you will want to update the pre-approval with the newest set of pay stubs. What if they're no longer employed there? What if they got a raise? What if their hours were cut and now they have a different schedule? So you do have to keep updating that pre-approval depending on the document sets provided. The pre-approval will be a conditional approval, basically a credit and income approval for a specific loan amount, right? You're pre-approved up to, if they're pre-approved up to a $250,000 loan, and it's 80% LTV. So then you're going to figure out then it's whatever is going to be the full purchase price that they can qualify for, and that's what you're going to fill out on the pre-approval letter. The pre-approval process, due to the fact that it is a more detailed and involved process, it will give the borrower more confidence in their buying power. They will be basically locked and loaded and be an offer making machine, because they know that the pre-approval that they receive from the mortgage calculator is ironclad, and all they need to do is provide the MLO with a fully executed contract to officially start the loan, the formal loan application process. As mentioned in the first slide, sellers and agents take pre-approved buyers more seriously. So this is something to consider in those tight inventory markets, right, where there's multiple offers, you want your borrower's offer to rise to the top, right? They talk about the cream rises to the top. That's what we want. So you want your borrower's offer to shine above all others, and the solid pre-approval is definitely one tool to allow that to happen. Now, please do note that since a pre-approval does require a hard credit pull, do be aware that it may affect the credit score by a couple of points. So if your borrower is on the cusp, right, if it's a 680 is the credit tier that they need to be at or above, and they're at a 680 now, the fact that you pull the credit now, and if that credit expires, credit reports are good for anywhere from 90 to 120 days. It really depends where you're going to submit the file. Some investors don't allow their credit report to be older than 60 days. Some don't allow it to be older than 30 days. So it does vary, something you're going to have to review, but to be aware that may come up. Now, the pre-approval, this is what dissuades some MLOs from embarking on an actual pre-approval process, is because it requires more documentation and more time spent up front. But remember, spending that additional time up front is going to yield amazing results when the borrower does provide the contract, or if they decide on a refi, this is it, I'm ready to go, then the application and closing is going to occur very quickly because your file is ready. Your file is set up. All you need is, the address. Please also note, I already mentioned about competitive edge in tight multiple offer markets, but above and beyond, the pre-approval allows the MLO to be the loan consultant, build credibility, and gain trust, because without credibility and trust in this industry, you're not going to get very far, as usually this is the largest financial transaction of most borrowers' lives. And last but not least, let's break down the pre-approval. You see our MLO there. She's on the phone with the borrower. She's just informally obtaining information from the borrower. She's writing down. This is like what you would do when you are on the call, that initial call with the borrower, right? You make contact. They clicked on the ad. You're calling them back. This is I usually equate the borrower call to obtain information as a pre-qualification call, right? You're writing down information, you're sizing up the deal, you're asking them about their credit, how they know that that's their credit score. If they have Credit Karma, if they have the Experian app or whatever other app they may have, or maybe they can share some screenshots or some PDFs with you to confirm what their credit score is, to confirm what their account balances are, to see where they are, current balance versus available limit, because that's where you can already start consulting them a little bit about possibly paying down some accounts. If you do identify some issues, like they're telling you they're 90% at limit on their cards and they have a 670 credit score, then you can basically discuss, how we can offer the credit simulation once a hard pull is obtained, and you can let them know what they could do to pay down some accounts to increase their credit score. So that call with the borrower is essentially the pre-qualification call, right? It's borrower self-reported, unverified financial info, and no or soft credit pull, no automated underwriting, and minimal guidelines review, because you really don't have any hard data to really chew on. It's just unverified information that all you're really going to be able to do is provide a general estimate of how much a borrower can possibly qualify for, right? Quick and simple process where you're only offering an estimated amount. But at that point, that's when you're sizing up the deal, and then you can see which are the viable quotes that you can send for your borrower based on your initial quick review. They told you they make $5,000 a month, and they are a salaried employee, and they told you they want a $300,000 home, and they can put 5% down, and they have a 700 credit score, and they got $25,000 in the bank. And so you can do some quick. Oh, and their minimum payment on their credit cards total is $300, and they have a $300 car payment and no other debt. you can quickly calculate their DTI based on the information they've provided, and then send them viable quote options, and then discuss with them why you're sending those quote options based on the initial review of the information that they provided over the phone, right? The pre-qualification obviously is a useful tool for early stage planning when they're considering multiple loan options, but it offers little to no credibility to sellers and realtors. So it's good to let them know, yeah, we could do full doc if if the income is actually what you're letting me know it is after I review the tax returns. But just in case, since you're self-employed, we're also going to send you a bank statement loan option, and we're also going to send you a profit and loss loan option. And if it's an investment property, we're also going to send you a DSCR option, and then to give you some more topics there to engage the borrower and fine tune the deal. And last but not least, please do note that the loan amount is not set, right? There is no official hard credit pull, and there is no review of the documentation. So, hence, a pre qualification letter based on all of this estimated and unverified information would not be a useful tool for home shopping, would not give any credibility to the MLO. And the way I see it is just setting yourself up for a headache should all of a sudden they get on the contract. And when you do go to pre approve them, you do the hard pull, you receive the assets and income information, and now all of a sudden everything changes. So don't set yourself up to fail, set yourself up to succeed. Try to do as thorough of a job as possible, gain credibility, and you will have a sustainable MLO career.
All right. Thank you, Jose. I don't see any questions here, but definitely an important topic. And loan officers always want to be as thorough as possible. And like you said, not not get in that position, right? So, still no questions here. We'll go ahead and wrap it up. Remember that we do this every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern, where we go through a new loan officer training topic. So we'll see you tomorrow, 12 p.m. Eastern.